Welcome to the Iconic Wealth Management Annual Halftime Report. We're happy to have all of you here today and look forward to sharing some important market information with you. Before we begin, a quick reminder note for those who are unfamiliar. My name is Steve Memory. I am the founder and Chief Investment Officer at Iconic Wealth Management, and I have been in the investment industry for over 20 years now. How quickly time flies. If you have any questions throughout this presentation, please feel free to ask. We encourage that. We have actually set up an email specifically to answer any questions you might have during this presentation. If you'd prefer to wait until after the presentation and ask your question in person, feel free to give us a call at 703-891-9518. I'm happy to answer any question you have to the best of my ability. I'd like to draw your attention quickly to these disclosures so we can keep the regulators and attorneys happy. Our goal today is to walk through some market fundamentals from the first half of 2018. Of course, it would be impossible to cover everything that's happened thus far this year. We believe, though, that tuning out the talking heads and focusing on market fundamentals will give us a clearer picture of the economy. Today, we'll look at where we've been, where we are, and what may lie ahead. This broad view may help you stay informed and give you a better understanding of the perspectives guiding our investment process. With that said, here's what we'll cover today. First, a review of the first half of the 2018, specifically focusing on the U.S. markets. A closer look at what drove U.S. equity market performance thus far. And then, of course, our second half forecast, specifically emphasizing fundamentals. Let's begin by reviewing how the markets performed during the first half of 2018. Here's a snapshot of Standard & Poor's 500 index performance for the first 6 months of 2018. The S&P index tracks the market capitalization of 500 large domestic stocks. This index is a common benchmark for analyzing performance of the U.S. economy. The S&P ended 2017 at 2674 and closed June 29th at 2718. This marked the 8th year in a row when the S&P 500 had positive performance in the year's first half. In fact, the economic recovery is now the second longest in history and may go on to break new records. But the continuing growth included some increasing volatility along the way. In January, markets hit new highs before tumbling back to earth in February. By February 9th, the S&P 500 was in correction territory. It had dropped at least 10% from its previous high. Of course, one topic dominated headlines throughout the first half of 2018, and that was trade. We take a look at some of the chart positions here. You can see where on March 8th, Trump ordered the steel and aluminum tariffs. That subsequent decline that occurred just a few days later was accelerated by the March 21st Fed raising of interest rates. You can see a lot of the volatility that subsequently took place, particularly given the $50 billion of new tariffs on Chinese products and China announcing counter tariffs. Everything kind of settled out. We had a nice finish to the 6 months, but the tariff situation presented itself a number of times and carries with us into the second half here. Now, each year, various media outlets compile many of Wall Street's top analyst prediction for the year ahead. These are the January numbers. As you can see, their 2018 estimates cover a 750-point range. That's from 2350 to 3100, proof that experts often have differing opinions. And while the results vary, one trend is consistent. All but one analyst predicted that the S&P 500 would continue to rise in 2018. Of the analysts we've included here, their average estimate of 2863 equals about 7.1% growth. So how do predictions compare to reality thus far? The S&P 500 finished the first half of the year at 2718 for a 1.7% increase over the start of last year. In other words, we're seeing positive performance, but the S&P 500 has experienced less than half of the growth predicted for all of 2018. Now that could mean either we see a significant increase in growth for the second half, or it means that some of the forecasts are off the mark. We're going to walk through some of the driving forces from Q1 and Q2 and revisit these numbers later in the presentation. Now let's look at some specific economic sectors to better understand how we got here. To put today's economy in perspective, let's take a look back to December of 2008, when we were in the midst of the worst financial recession in 80 years. Here you see 20 speedometers representing 20 leading financial indicators. 15 of the 20 are in red, which correlates to negative or weakening numbers. There's a lot of red on that screen, right? By comparison, though, take a look at January 2018. We have 17 out of the 20 leading financial indicators are reporting positive or strengthening numbers. Those appear in green. We do see yellow in the political environment and equity market valuation. Geopolitical risk is the only red on the screen. In June, the speedometer showed a similar positive perspective. From the U.S. economic outlook to inflation to housing, most of the speedometers are green. According to City National Rochdale, which creates these charts, the indicators show widespread strength and continue to signal modest U.S. economic growth ahead. As you saw on the previous two slides, geopolitical risk is the only area of our economy currently in red. One major contributor to that is the trade tensions that we've experienced so far in 2018. A brief background. For years, the U.S. has had an unbalanced trade relationship with China. From pirating our technology to charging us higher tariffs, China enjoys significant leeway as we encouraged its economic development. The Trump administration believes China's economy has grown enough to handle more equitable trade arrangements. As part of this push, the administration has added new tariffs to imports from China. In return, China has retaliated with tariffs on our own goods. Now, China is not the only trade relationship that the Trump administration is reevaluating. Steel and aluminum tariffs now affect many countries. In fact, these were some of the first tariffs to be implemented. And these include some of our key trading partners, such as Canada and the EU. Those countries are now promising retaliatory tariffs in response. No one knows for sure whether this trade tension will escalate into an all-out trade war. If it does, our economic growth could suffer. While the markets continue to respond to tariffs, for now at least, they haven't overreacted to the headlines. Instead, they've largely chosen to focus on more fundamental details. And we all know that geopolitical headlines have dominated conversations in 2018. But another less flashy topic has driven market performance so far this year, and that would be corporate earnings. First quarter earnings were especially strong. 78.2% of S&P 500 companies beat their earnings estimates. They also averaged a whopping 26.6% increase over the same time last year. Companies released their second quarter earnings results in July, and analysts expect another similarly strong performance. Recent estimates predict an average of over 20% growth in year-over-year earnings. Corporate earnings have been on the rise since the third quarter of 2016, and analysts expect at least several more quarters of positive performance ahead. The Federal Reserve aims to create a monetary policy that supports, quote, maximum employment, stable prices, and moderate long-term interest rates, unquote. As it works to uphold this goal, the Fed watches inflation to determine how and when to adjust interest rates. It uses the Index for Personal Consumption Expenditures, also known as the PCE, or the PCE deflator, as its primary source for inflation data. From the Fed's perspective, a 2% interest rate is ideal. Now, if you look to the box inside the line graph, you see that both headline and core PCE were at or above the Fed's inflation goals. The Consumer Price Index, or CPI, another measure of the economy's prices, is also above 2%. So far in 2018, the Fed has raised interest rates twice, and it indicated 2 more hikes could occur later this year. When announcing the last rate increase, Fed Chair Jerome Powell said, "The U.S. economy is in great shape." That's nice to hear. Rising interest rates generally cool economic activity, thus lowering inflationary pressure. This is because borrowing becomes more expensive and consumers tend to save more. Now, the unemployment rate in the U.S. continues to be low. In May, it reached 3.8%. That's its lowest reading since the year 2000. The rate bumped up to 4% in June as more unemployed people began looking for work. Rather than being a negative factor, this increase shows that previously disheartened workers are feeling good enough about their job prospects to re-enter the labor market. And 4% unemployment is still well below the 50-year average of 6.2%. Wage growth has also steadily increased as the labor market improved. These tend to go hand in hand. We'd like to see slightly better wage growth, but it's an improvement nonetheless, although these statistics point to a healthy labor picture. The University of Michigan Sentiment Index is one of the most widely used sources to help analysts get a grasp on how the average consumer feels about the economy. This is an important factor in consumer spending, which accounts for more than 2/3 of the economy. In March, the index hit its highest point since 2004. While concerns about tariffs affected some people in the most recent consumer sentiment survey, 2018's readings remain high. Taking a look at residential real estate, even though a shortage of previously owned homes sent sales even lower, putting a squeeze on the real estate market, but nowhere near where they were before the crash. Home sales in May were 3% lower than a year ago. April sales were also down. Median home sales prices rose nearly 5% in May. Overall, home sales are still trending positively. While home prices are rising, housing is actually becoming more affordable when you look at mortgage payments as compared to household income. According to the Housing Affordability Index, the average mortgage payment as a percentage of household income is 13.4%. That's below the 50-year average of 19.3%. And that's good news for your average American home buyer. But before we move on to our forecast for the second half of 2018, let's take a moment to revisit 2 different visions of the future we presented in our State of the Markets address. This was back in January. We showed the hypothetical newspaper headlines for positive and negative possibilities. 6 months into the year, which storylines seem more in keeping with where we are today? Well, there's the one about the trade wars. That was a little bit prescient there. But while the trade wars are making headlines, growth and stability seem to have offset these negatives, for the time being anyway. Now let's turn to the second half of the year. Industry analysts in aggregate predict that the S&P 500 will see a 13% increase in price over the next 12 months. This percentage is based on the difference between the bottom-up target price and the closing price for the index as of July 5th, direct from the link above, which is insight.factset.com, for those of you who wish to go check that out. In the first quarter of 2018, the gross domestic product, or GDP, increased by 2%. That's a bit lower than the 2.3% growth we experienced in 2017. But many analysts believe the second quarter readings could be much higher. Estimates have gone as high as 4.8% annual growth, while the recent readings landed in the mid-threes. Even at that 3 level, our economy would be growing faster than it has in several years. And in fact, the number that was given us here today, that's July 27th, is the economy grew at a 4.1% rate in the second quarter. This chart shows the median projections from the Federal Reserve Open Market Committee. As you can see, it expects GDP to continue expanding at a relatively steady pace for the next few years. As we discussed earlier, corporate earnings were strong in the first quarter. We haven't yet received the full reports for the second quarter earnings, but recent estimates point to an average of about 20% growth for the S&P 500 companies. Analysts expect corporate earnings to continue to grow in the second half of 2018. In fact, we could experience continued double-digit earnings growth through at least the end of 2018. The Federal Reserve has already raised interest rates twice this year. It has also indicated that 2 or more rate hikes could occur in 2018, with the possibility of 3 increases for 2019. After the June rate increase, Fed Chairman Jerome Powell expressed confidence in the economy's strength. He explained that people are finding jobs and both inflation and unemployment are low. At the same time the Fed is raising rates, it is also trying to unwind the $4 trillion in bonds it bought during the financial crisis. This unprecedented process, known as quantitative tightening, is beginning to affect bond markets. It could contribute to short and long-term yields becoming very similar, which can indicate slower growth is ahead. We won't go into the nitty-gritty of the details here, but essentially the Fed must address multiple goals as it moves forward. Those would be raise interest rates at an appropriate pace, continue the quantitative tightening, and watch the bond market closely. Ultimately, rising interest rates are a sign that the economy is doing well. But what exactly happens when interest rates rise? Well, let's take a look at the chart. The yellow dotted line represents a 5% yield on a 10-year Treasury note. If you look at the placement of the brown diamonds, you'll see that most of them cluster in the upper left and the lower right quadrants. This pattern shows us that when rates are below 5%, equities tend to grow when rates increase. But when rates are above 5%, equities tend to decrease in response to rate increases. In other words, history shows us markets may rise as rates increase as long as they stay below 5%. Rising inflation and interest rates may negatively affect one area of the markets, that is fixed income. In the last slide, we saw the correlation between rising interest rates and a rising stock market. The data also shows that this scenario can cause bond yields to rise as well. While increasing yields might seem like a positive scenario, yields and prices have an inverse relationship. So generally, the more bonds are yielding, the less your bond may be worth if you sell prior to maturity. After experiencing years of low interest rates, many investors may be surprised to see that their bonds can lose money if sold prior to maturity. It does happen. Bond fund values may decline during periods of rising interest rates, But a changing tide in the economy doesn't mean you have to abandon fixed income. Often, this movement is an important part of a well-balanced, diversified portfolio that provides income, which investors need, as well as the diversification to balance out your portfolio. Instead, pay closer attention to bond risks and opportunities, and keep an eye on inflation and interest rates in 2018. We will also continue to monitor the geopolitical uncertainty that can significantly affect fixed income yields. Tuning out political noise while managing your finances is not always easy. However, investing wisely involves more than reacting to soft factors like consumer sentiment or geopolitical tremors. For investing opportunities, we urge you to stay focused on company earnings and global economic data. In other words, we encourage you to focus on the fundamentals. And as always, it's important to have a discipline and then stick to the discipline. We've gotten over a lot today, but if you remember just one detail from our presentation, we hope it's this: emotions have no place in investing. Market corrections are not something to fear. They are a normal part of market cycles. If volatility feels especially uncomfortable for you this year, it may be because 2017 was unusually calm. The chart here shows the intra-year lows each year going back to 1980. Those are in brown with the annual returns in gray. Last year, we experienced only a 3% intra-year drop, coupled with a 19% growth. Wouldn't we love to have those years every year, right? Here you'll see that last year's performance isn't normal. Instead, volatility in the stock market is common. In fact, despite an average intra-year drop of 13.8%, the annual returns are positive for 29 out of the last 38 years. Could there be a correction coming? Well, yes. But should it derail you from your long-term investing goals? No, absolutely not. If you ever feel concerned or want to understand what's happening, please lean on us for support. We're here for you, and we want to help you make the most of your financial life. Now, how do we tune out noise, right? I mean, the news outlets need to pull in viewers. We know this. It's just a function of business, right? But they do this by turning minor events into breaking news headlines. This chart shows S&P 500 price performance between 2004 and 2014 and CNBC viewership over the same period. So what do you see as the correlation? You'll notice how viewership spiked as the stock market fell during the financial crisis. People tend to focus on negative information, and they turn to media in times of crises. On the other hand, viewership drops as market performance improves. In 2017, CNBC hit its lowest viewership in 22 years. Last year also happened to be one of the calmest markets on record. We know that this year is presenting many opportunities to question where the markets are going and what that means for you. But remember this chart. The next time a talking head is yelling about current events, drama may increase viewership, but the markets have other drivers. Tune out the noise. Let's filter through the headlines, and we'll keep you informed. If you have any questions about things, then feel free to pick up the phone, give us a call, and we're happy to answer any questions. Speaking of which, we've talked about a lot of points today, and I'm sure some thoughts have emerged. So don't hesitate to give us a call or send us an email. You can reach us at the email we've set up for State of the Market at iconicwealth.com. You can call directly 703-891-9518. We are always happy to talk. Thanks so much for your time today. We hope that you enjoyed the information we've shared. For more information and timely updates, drop by our Facebook page or visit our website at www.iconic-wealth.com. Be sure to include that dash. And we look forward to seeing you soon. Thank you very much.